Hey, what's up, everyone? This is Charlie from Lifetime Success Journey, and I want to thank you for joining me today. Happy Friday, by the way. So, today I'm going to talk about how to analyze a balance sheet. So, for anyone that doesn't know, a balance sheet is how a company is doing at any particular point in time. Given that, you can compare past balance sheets that they report annually on their 10K and see how a company performs over time, whether the operations or what they've said they're going to do has really been executed and has really helped out the company or has actually brought down its performances / standings. So with that said, let's get right into the video. So to start off, EPS is earnings per share, PE, price to earnings, PS, price to sales. Gross profit is another part of PS, which is instead of just overall sales, it's price to gross profit. PB is price to book value is what it said, dividend yield, and div ratio. There is a second portion to this that I will list up right after we go over these to signify the second part of this. So now, the first two, EPS and PE, are probably the most popular metrics used by anyone that invests, and I'm pretty sure most of y'all will be familiar with this. So you can just about get these numbers from any website, whether it be your brokerage, NASDAQ.com, or any other place, Yahoo Finance. But basically, if you don't know what exactly it is, or if you want to just get a quick recap, EPS is net income over shares outstanding. So whatever's left over of pure profit at the end of the year is divided by the number of shares outstanding, and that's how you get your EPS for a company. Second off, PE ratio. So PE ratio is the price per share divided by the earnings per share. So that's how we determine if something is overvalued or undervalued. Is basically you take the price of whatever stock you're looking at and divide it by its EPS. That's basically tells you what value, whether it's growth potential or maybe overvalued. Typically, a good like recommendable stock would be anywhere from 11 to 15. 20 is a little high, but growth stocks do show that a lot because they have a lot of high potential for growth, and so you have to factor that in as the market is also anticipating lots of growth. So those, depending on what stock you're looking at, it's good to look at the industry and competitors to get a rough idea of what a typical EPS for that industry or company is average or good or bad. So it's all of this can be dependent on further research. Now, price to sales. So price to sales ratio, basically that's the entire market cap divided by your total revenue or total sales for the year. This gives an idea of how fast a company can produce what it is valued at. So that's a good indication. Like you just get a good look at it to give you an idea of how good sales are. But one thing to keep in mind, I realized that some companies' cost of goods sold and the gross profit that remains after is significantly less, sometimes even negative, from the actual regular revenue. So if you're really taking in mind, despite that, if you have a high cost of goods sold, then you're still having can be a negative EPS. Therefore, company may not be looking well. Those sales, yes, are rising. Those costs of goods are also rising with it, and therefore, if you don't make enough of gross profit, or don't have enough good of a profit margin to continue to support and justify those higher sales, then you're really just increasing sales for no reason. It's going nowhere. So that's why we added to a second part of this, the gross profit. So that's after cost of goods sold. So gross profit is right before your business administration expenses, any other expenses that you have, maybe it'd be R&D, new capital, that you've bought recently, some new assets. So basically, from that, it's like cash flow, where you want it to go, and what you look at investments to look in, what growth opportunities are you looking at. So that's actually, I think, a better measurement, but it's good to have this first. So that would be market cap divided by gross profit. Next, we have PB ratio, which is the price to book value. So again, this is book value. With these, a balance sheet, the book value may vary from company to company and even on different websites. The reason being, different companies and different places have different ways of researching what they do. So you may see one number here and a complete different number on a different website. Who's right? Well, it really just depends the way you calculate it. For example, if you've ever read the book Security Analysis, one thing that they did to really be very conservative, they used 40% of inventory. So meaning these total assets would have dropped for current assets. So that would also affect the current ratio, which we're going to go over in a little bit. But these assets would be significantly lower. These liabilities would not change. So therefore, how fast liquid a company would be a lot less than what's shown on the balance sheet. Therefore, showing a smaller book value. That is a very conservative approach. I've realized that we're currently in a bull market, the longest bull market in forever maybe. But what's it called? So it's good to keep in mind that these balance sheets are stronger than most, and book value will usually be under the actual price. So for right now, I don't think it's really critical that we use a conservative approach to book value, as long as these check out regularly. And again, this is really simple, so instead of going way more into it, just keep in mind that this is still a good way to go about it. So you just use all your, you would go to, in order to find the book value, you would see all the total assets. Oh, and by the way, if you want to find a way to find all this, it's all in the 10K. But a 10K may be really confusing to read sometimes if you've never looked at one, and to go scroll around the data. So what's maybe more convenient, you can go to NASDAQ.com and look up the stocks. I've compared what they have under their income statement. When you look at a company, you can see the income statement, the balance sheet, some other financial ratios, etc. EPS growth, and EPS is another one to look at. There's a PEG ratio, really hard to calculate, so I did not include it in this board, but I'll kind of go over it a little bit. But continuing on with that, yeah, so if you don't want to look at the 10K, scroll around, look for the data that you need for this, you can just go to NASDAQ and look at the income statement, as well as the summary quote. That'll give you the EPS and PE right away. For the EPS, by the way, if the company's not profitable, so they don't have a positive net income, then the PE is going to be non-existent, because you can't really have any, you're not earning anything if you're negative. You're actually losing. So you have a negative EPS, and you can't really have a negative valuation. So continuing on. So yeah, total assets minus total liabilities, that gives you basically your equity. And so you divide that by shares outstanding. So that gives you the price of the book value of the price. So if we were to go bankrupt or something and just have to sell everything, so we sell everything, and this is what we can probably get paid back for those who have invested in it. So it's a good idea. And then you divide the price by the book value. Again, this depends on industry or companies you're looking at. You want to look at similar competition to see what their book values are and how they compare. This isn't really the biggest deal breaker because, like I said, different measurements value different way, but it's always good to have in the back of your mind, and it's good to picture it when you look at this. So, dividend, the way this is done is you look at the current dividend, whether it be quarterly, semi-annually, annually, and you look at the annual dividend, so you have that. Then you to find the yield, you divide that dividend by the price per share. So that'll give you your yield. From there, you continue on to div ratio. So whatever that dividend per share is, again, the same number derived here, which is now here. So the dividend for the year, you divide by the EPS, and that gives you your dividend ratio. So that determines how safe a company is with its dividend, if it's likely to cut its dividend in the future, or maybe possibly have space to increase as well. So those of you that are looking for income or rising dividends while holding a company, or just want income in general for life, personally, my strategy, I have some growth stocks, but I also have dividend stocks, and I have income stocks, which are basically dividend stocks that pay a higher yield, because one day I do want to live off of dividends. So that would be that my dividends pay for all my bills and everything and still support me. So from that, this ratio is very important. Because if you're investing for yield and a ratio and the price in general, if a dividend ever gets cut, you can definitely bet that price is going down. First off. Second off, if a dividend yield or if a dividend ratio is too high, if any bad times come or anything surprising comes that's not expected, maybe some type of litigation, then you can also expect the dividend to get cut, and again, price will drop. So though, don't sacrifice safety for yield. That's very important. Alright, well that's basically for the first part. I'm gonna pause the video. I'm gonna cut up to the next part just so you can see the next part of the balance sheet. Okay, I just finished writing everything up, so now let's go over the second half of the balance sheet. So now, next ratio we're going to want to figure out is, actually let me explain first what the ratios are. There's ROA, return on assets, ROE, return on equity, equity, debt, current, quick, and cash. These are all ratios. So now, for ROA, so that is net income over total assets. So yes, that is your profit at the end of the year, your net income, and then divided by all the assets you own. That'll give you a certain percentage of how much you make and how efficient you're using those assets. Now we have return on equity. So basically what people want to see is that you're making a high return on what you're investing. So similar to ROI, return on investment, return on equity is what you actually have put in. A quick, easy definition for equity would be, for example, I guess for anyone else more common rather than a house, a car. When you buy a car and you put a down payment, that down payment is your equity in the car. What you owe is the liability. So that's how efficient you're using. So that's just quick terminology. So basically, you'll always see assets more than equity because we have extra liabilities. That's leverage. That's money we're borrowing to be more efficient and earn a higher return on our equity. So with that, net income over total equity, that should be a little smaller than ROA, but still should be significant enough that you're seeing a high enough return to merit that the company is good enough for investment. Equity, so your equity ratio, that's going to be your total equity divided by total assets. So that at that point, that allows you to see how much of the company you actually own. Debt equity. So debt equity is total liabilities divided by total equity. So that kind of shows you what you owe and everything to total equity, what you really own. Then we have debt. So debt is total liabilities divided by total assets. That gives you your debt ratio. This is a very, very, very important ratio. You typically don't want to see this above a 0.7. 0.75 is like, all right, that's pushing a little bit. Because like I said before, same with the dividend ratio, if it gets too high, the dividend ratio shouldn't pass 0.7 as well. 0.7 is basically that nice cutoff for any conservative investor that really matters about their precious capital. Because number one rule of investing is always don't lose money. And number two, follow rule number one, Warren Buffett. So anyway, so you definitely want to protect against any capital loss. And any high risk. So this debt ratio is very important when looking at a company. So given that, this total liabilities divided by total assets. And so that's for the long term. This overall company performance, overall company standing, Current ratio would be current within the given year. Any given year, just 1 year's time. So for current, it's current assets divided by current liabilities. That's your ability to pay any liabilities within the year. Quick ratio is your current liabilities minus inventory, because again, inventory can be slow moving unless you sell at a deep discount. Therefore, it really wouldn't be a current, or you can't really fully value it. So quick ratio, current liabilities, current assets. That's a mistaken input. It's current assets. Minus inventory divided by current liabilities. And then finally, the cash ratio. Cash and cash equivalents divided by current liabilities. Again, if you notice a kind of repeating theme in this, it's what's our ability to meet liabilities and how safe the company is overall in its standing. Because the one thing we don't want our company to do is to go out of business, A, and B, to be able to maintain processes even in hard times, when hard times come, and they will come. Whether it be 5 years, 10 years, next year, who knows? But you always want to, if we're investing for the long term, we want to invest in safe, secure, good, strong companies. So that's why this is all very important. For these ratios, typically I would like to see these above a 1, It doesn't have to be. It's not like a cutoff. But this current definitely should be at least a little higher up than the rest. Close to 1, if not over 1 at the minimum. So that's that. Unless the other ratios can really justify and sort of persuade to see how efficient they are to maybe justify that this isn't as high, then I'll take that into consideration. You always want to take different factors into consideration. No company is going to be perfect. So there is no strict cutoffs. Just keep in mind that it's upon one's decision how much risk they want to take, and one's comfortable. If you can sleep well at night, then that's perfect. That's what you want. You don't want to be stressed out. Oh crap, I really hope this company doesn't go down today or this company goes under. That's why we do the analysis beforehand and the research, your due diligence beforehand, in order to stay safe and be confident in our company, regardless if it's going up or down, because we're in it for the long term. So given that, that's about it. That's everything. This is a quick at how to conduct a balance sheet analysis. And if you need any help, actually right after this, I'm going to write down the numbers of what I got for AT&T, just on this, based on this, really. For these, an easy way to do this, instead of calculating all out, you can literally just go to the financial ratios on NASDAQ for a given company. The same thing with EPS and PE, but all the middle stuff, all the stuffing, that I recommend you calculate on your own. Different places. Sometimes you might find one that has similar to the right, same things that you calculate. Other times you'll find other places nowhere near the ballpark. So therefore, you really want to do your own research. I can't stress this enough. And plus, in doing it itself, you really start to become familiar with the company, and you start, well, basically having a sense of ownership. If you do invest in it, you know what you're looking at. You know what you own. So it's always good to look at this and really get a feel for the company. So given that, I'll write down the numbers for each one for AT&T. As I'll cut this off real quick, and then you can compare. These were numbers taken from Nasdaq.com. You looked up. I look up the stock ticker symbol T for AT&T. I'll look at the summary quote, another tab for the income statement, another tab for EPS, which is separate. That's separate for the PEG ratio, and just see how earnings are doing over time. Rather than talk about the PEG ratio, just look at earnings and see the trend, see where it's going. If it's going up, down, roughly, get a good idea. That'll just be a quick look. But everything else is derived from the balance sheet. Now, this is just upon stock screening. So first, what I'll do when selecting a stock, I'll screen based on price, a little bit of technical analysis, or another. But writing down everything for the past 3 years, prices for quarters, highs and lows, and I'll see what companies are showing that they're low compared to their average value, their intrinsic value for that matter. And then I'll start, if one attracts me with a large margin of safety, I typically look for it's 15%. We'll take 10% sometimes, depending on how what stock we're looking at, but typically, normally not less than 10% margin of safety, but 15 is preferred. And then upon that, if I do see a company that I like, and that's looking pretty good, and a good industry, something that I'm looking at, then I'll conduct a balance sheet, a simple balance sheet analysis like this. And if the numbers are strong, numbers are good, then I'll continue on to look at the income statement and see where the cash flows are going, how everything's being run. And if still that's good, I'll look at some earnings report, I'll do a qualitative analysis of any other news and stuff, and basically get a general outlook for the company. What projects are they working on? What are their growth prospects? The 10K overview of everything, the proxy statement. Those are all very important as the whole process. But simple, that way you don't waste all your time looking through stocks. You can just figure out how to cross out a lot of ones just using this formula and a attractive valuation. So without further ado, I'll put up the AT&T formulas, and if you didn't get the same numbers that I did, maybe it's because a little time has passed. Actually, strike that. This will be from today. Literally, I'll do it all over again today because it's pretty quick at this point. And if your numbers don't match up from this date, then you can send me a message on how I calculated it, or maybe I was wrong. Who knows? But yeah. And again, as I like to stress out that I am long AT&T for disclosure purposes. I do own AT&T. And so this video is also made for your entertainment only. I am not a licensed professional, So if you're seeking investment advice, please contact a professional or financial advisor, and hope you enjoy the video.